Alrighty, let's just jump right into this. Welcome guys, and welcome to Hoskin Capital's first YouTube video. I'm Nate Hoskin, I'm a certified financial planner. I'm also the Chief Investment Officer for Hoskin Capital, and the entire goal of this channel is just to share the adventures that I have had in learning to invest and becoming a better investor myself. I'm going to be telling those stories as well as giving you the basics, the rundown, and then we will start to get into some of the more interesting and more advanced methodologies, the ones that we apply at Hoskin Capital, the ones that are applied at quantitative hedge funds like Point72, as well as the ones that you might see in a couple of the ETFs that you own. We'll talk about all of these strategies and more right here. I hope this goes without saying, but the absolute worst way to invest is just by not investing. Just start. Because the earlier you get moving, the more money you're going to make, regardless of how many mistakes you actually end up making. If you are 20 years old and you invest $100 a month for 45 years, you're gonna end up with $342,000 at the age of 65. If you wait just 5 years and you only get 40 years of compounding, you're only going to end up with $232,000. Of course, all of this is assuming a 7% interest rate, which is quite reasonable. The historical returns for the S&P 500 over the last 60 years have actually been closer to 11%. We've established that starting young is incredibly important, but where do you start? How do you actually begin investing, and what does that process look like? Lucky for you, there are an insane amount of options that we can actually go out and explore, so let's talk about a couple of them. There are two main categories of ways that you can invest. You can work with a broker-dealer, or you can work with a registered investment advisor. So a broker-dealer are, for example, Fidelity, Charles Schwab, or Robinhood. All these firms do is they provide you the platform on which to make investments. They don't necessarily provide you any recommendations on what you should invest in or anything of that sort. They might provide you research and allow you to make more educated decisions, but they will never make direct recommendations on what you should buy. We're sort of out of the phase where your broker-dealer used to call you up and say, hey, I have this great idea, you should buy 100 shares of Apple. It is pretty much entirely self-directed. On the other hand, a registered investment advisor is designed to manage your portfolio for you. This is by far the best for someone who knows that investing is important and knows that they should be doing this, but don't necessarily have the know-how or just don't have the time to actually invest their own capital. For people who want to use RIAs, they tend to be a little bit more expensive because you are paying what is called a management fee. But the flip side is that they're going to fully manage your money for you. They are going to take your capital and they are going to place it in a portfolio according to their strategy. And they're going to be very transparent about what that strategy is, and they are also required to show you exactly what you are holding, as well as what you are paying in fees down the entire line. So regardless of which one you choose, investing is the number one priority. And so even if you just open a brokerage account and you go and buy an index fund, and I will talk about what an index fund is later, that is the perfect place to start, because the goal is to create discipline and to create a rhythm in which you consistently invest and build your assets. So for the remainder of this video, let's just walk out what it would look like to work with a broker-dealer or to work with a registered investment advisor. Let's talk about what that process looks like. So as I mentioned, the broker-dealer is self-directed. So you need to go out and figure out what sort of stocks to buy, whether you're talking to your friends or you're doing your own research. There will be a combination of what is called information flow, right? Where you're going to get your ideas and then how you're going to justify those ideas. So we'll talk a little bit about how to deal with that information flow and how to make really educated decisions. And then we'll also talk about how to properly monitor a registered investment advisor to make sure that they're providing you with the best service that you deserve, as well as make sure that you understand what's going on, so that you know the fees that you're paying and you also understand what their strategy looks like. When you're just starting out picking stocks, the number one thing to look at is this company doing something that is innovative? That is going to be the main driver of your portfolio. Look at the ones that have performed unbelievably well over the last 2 decades. We're talking about Amazon, we're looking at Google, Microsoft. These are the types of companies that genuinely and tangibly change the way that we live our lives today. They changed how we operate. They changed the software that we use. I use many of their applications every single day. I mean, when I go to edit this video, the video is going to be uploaded to Google Drive. That is how integrated these companies are with our lifestyle. That is one of the most important things to look at when you pick a stock. The next really important component is that you need to understand if that company is good at what they're doing. And so one of the simplest things to look at is, are they consistently making more money year after year? Are they increasing their sales? Sales is great, but it's kind of easy to manipulate. Personally, one of the things that I like to look at the most is actually free cash flow. So free cash flow is after everything, after your expenses, after your taxes, after you add back depreciation and amortization, there is a line item that is called free cash flow. And you can find this on any of the applications that you might use to look at stocks. My favorite is Koyfin, but there is also Yahoo Finance. You can even pull most of this information off of the Excel plugin or the Google Sheets plugin. All of these will provide you with the same information, and you will be able to access that free cash flow number. The most important thing is that that free cash flow is increasing and that it is not volatile, because if the free cash flow is going insane and it's just constantly changing, that is the sign of a company that could be ill-managed, or it is the sign of a company that is consistently changing their direction and trying to figure out, should we do more research and development? Should we buy more buildings and have more capital expenditures? Or should we create free cash flow and use it to pay out as a dividend, or you do a share buyback? And that level of inconsistency is very challenging for an investor to keep up with. We will at some point do a deep dive in how to analyze a stock and what different metrics I look at and my team look at when we make a certain decision, but that's not the point of this video. The point of this video is that if you are going to make a purchase of an asset, whether that's a stock, that could be a derivative or a bond, I don't care. It could be cryptocurrency. You need to understand exactly what that asset is, what it does, and what it means for you. And so you need to go and you just need to read about said company or said cryptocurrency. And even if the financials don't necessarily back up your purchase, or it doesn't always seem like the best buy, if you feel that that company, based on all of your research, is going to do something incredibly innovative or is going to do something incredibly well, buy the stock. Because that takes me to my next point, which is that if you're interested in something or you have some sort of curiosity, for instance, let's say you have a curiosity in Amazon. The number one way you're going to learn the most about Amazon is you're just going to go buy a stock of Amazon. And that's going to force you to watch it. It's going to force you to listen to their earnings calls. It's going to force you to understand what their price action has been, how the graph has moved, these sorts of things. And you will find that just by owning the asset, even if it's $20 worth of Amazon, which is you can do with fractional shares, then you will learn more about Amazon than you ever would have as a bystander. So the second part of this video is about understanding how to work with a registered investment advisor for those of you who choose to have someone manage your money rather than doing it yourself. Hosking Capital is a registered investment advisor, and there are a couple of very important things that you should look for when you're looking at someone like us or someone like Betterment or Wealthfront. And the number one is fiduciary. So this word fiduciary is the legal and moral duty to act in the best interest of your clients. So all registered investment advisors are fiduciaries, but not all investment advisors and not all financial planners are fiduciaries. And so you should ask anyone that you work with, do you have a fiduciary obligation? Because that means that they are required legally to act in your best interest at all times. And if not, you have legal recourse to go get your money back or go be compensated for any damages that they might do down the line. I also believe that if you're going to hire a registered investment advisor to manage your money, they should be better at it than you are. And so you should understand the level of experience that they have. You should also understand whether or not they have been doing this for a while, if they have a good track record. And if you can, especially if it's a small shop, I would reach out to their clients and I would ask for their reference list so that you can go talk to people who work with them currently and understand their level of satisfaction with the service, with the performance, and with the portfolio. The third and final thing that I think is incredibly important when working with a registered investment advisor is transparency. You should be able to access some person in that firm and ask them any question, whether it is questions about your portfolio and actually helping you to understand what you are holding and what the objectives are of those holdings, as far as fees go, you should be able to have a very transparent fee schedule. And then when you get charged fees, you should receive a report on the fees that you paid. It should arrive every single quarter or every year, depending on when they actually charge fees. Finally, you should make sure that the registered investment advisor is adequately benchmarking themselves. So benchmarking is where you compare the performance of your portfolio against the performance of some other benchmark. Usually that benchmark is the S&P 500, because you can go and buy an S&P 500 index fund essentially for free. It costs 0.03% per year. So 0.03% of whatever you actually end up investing. And so that is the baseline. The investment advisor and the investment managers should be outperforming the S&P 500, particularly if they're going to be charging you additional fees, assuming that your risk matches the S&P 500. Because the S&P 500 is just the top 500 companies in the United States. And that is an incredibly risky holding. It has lost 40, 50% in some of its larger recessions. And so if your risk tolerance is that high, that is the proper benchmark. If your risk tolerance is lower, and therefore the risk in your portfolio is lower, your registered investment advisor should be providing you with a blended benchmark that adequately represents the risk and reward of your portfolio compared to that benchmark. My hope for this video was to just give you a place to start, because that is the number one priority. After this video, if you don't have an investment account, if you don't have a Roth IRA, go and start one. Doesn't necessarily need to be at Hoskin Capital. It could be with one of those broker dealers that I mentioned. It could be with another RIA, but it needs to happen, because those 5 years or even that 1 year that you miss out by pushing back investing could have enormously detrimental effects on your financial future. And as a fiduciary advisor, as a certified financial planner, my number one priority is to improve your financial future, even if I never meet you in person. In the next video, we're going to start talking about the options that you have for what to invest in. So today we talked about how to invest. Next time, we're going to talk about what you might invest in. For instance, stocks, bonds, real estate investment trusts, derivatives. I'm going to try to cover as many of them as I possibly can. After that, we're going to get into the real research bits. And we're going to start with fundamental research first, how to look at a company's financial performance and their financial metrics. Then we will get into some technical analysis, and then we will get into some quantitative analysis, and these will be a video each. Quantitative analysis is actually the statistical understanding of a stock and the correlations that it has with other components of the market. And this is where you can really start to understand what makes a stock tick, because remember, a stock is not the company. There is a separation. Understanding that separation and isolating the stock is one of the most important things that we as investors can do. If you made it this far, thank you. And I really hope you learned something, and I hope to see you in the next video. Thanks so much.